I'm Steve Strazza, and I'm here with JC Parets, the founder of Allstarcharts.com. Today, we want to talk a little bit about stocks, bonds, and gold, and their relationship to one another. JC, I saw you did a blog post last week looking at basically ratio charts of S&P over GLD, which is gold ETF, and S&P over TLT, which is the long-term Treasury ETF. What are you seeing out there?
Yeah, because think about it. When assets are in strong uptrends, they're not just doing well on their own, obviously, but they're also outperforming their alternatives. And when it comes to stocks, bonds and gold act as two very good alternatives to stocks. So it really gives us a good idea. Is money really flowing into the stock market? And with new all-time highs last month in the S&P 500, we've seen nothing but lower highs in S&Ps relative to bonds and lower highs in S&Ps relative to gold. So relative to bonds and gold, S&Ps are not making new all-time highs. They're actually pushing up against new 52-week lows.
So I saw in the charts that you posted, you're focusing on basically lower highs that were made between like September of last year and May of this year, two times when equities peaked, right? And then you're looking at the support level at the lows from December and watching that closely.
In both ratios, in the S&P relative to gold and S&Ps relative to bonds, we're right to where we were at the end of last year when stocks bottomed out and started rallying. We're right there now.
Right. Now, does it concern you a little bit? When I zoomed out on these charts, I could draw an uptrend line on stocks versus bonds. I could draw an uptrend line from when the market bottomed in March of 2009. It's been valid for 10 years and it was just violated.
Yeah. Well, it's not just the trend line. While that might be true, there's a lot of trend lines you can draw from a lot of starting points. The bigger thing, in my opinion, are the massive distribution tops that we've seen over the last couple of years in these ratios. So it's not just trend lines, right? It's the trend lines breaking and then there being distribution. So if we start taking out the lows in December of stocks relative to gold and stocks relative to bond, and we're below the December lows, that's not characteristic of a strong uptrend in stocks of any kind. So we really want to be cautious of what's going on near these lows. If they can manage to hold, and that does act as support again, that's consistent with higher prices in stocks.
So stocks and bonds can both trend higher together though, and stocks can simply underperform and this ratio could roll over, no?
Yeah, there's no question, but that's not the bet that we're making right now. I think if stocks are going higher, I think you're going to see a bid in rates. You and I have talked about it, right? What's keeping some of these underperforming countries around the world down? What's keeping small caps down? Exposure to banks, right? So I think that what it's going to be is if stocks are going higher, so are rates and bonds are coming off in that environment. I think gold is really the question mark. Can gold and stocks continue to rally together? That one I certainly think is possible. It's the bond one that I'm not quite convinced that that's the right bet we want to be making, that interest rates are going to go lower and stocks are going to go higher in that environment. For where we are right now, because obviously that's happened in the past, where we are today in this environment, that's not the bet I think is worth making.
Okay, so over the past decade or so, coming off the lows from the great financial crisis, stocks are up about 250%, and on a total return basis, bonds and gold are each up about 100%. So if you look at the trailing 12-month returns, you see a very different picture, where stocks are only up about 5% and gold and bonds are each up over 20%.
Yeah.
So what I'm wondering is, I'm going to bring out John Murphy and his principles on intermarket analysis.
I like it.
In an inflationary environment, which many would argue we were in, stocks and bonds can trend higher or trend lower together. And that's what we saw over the past 10 years, right?
Sure.
So now, I know this is out of your wheelhouse, but PCE, which is the Personal Consumption Expenditure Index, which is what the Federal Reserve watches for inflation, that kind of topped out and rolled over at about 2% last fall. So now many would argue that we're in a disinflationary environment. In that type of an environment, according to John Murphy, stocks and bonds decouple and trend in opposite directions.
Yeah.
Could we be in an environment where stocks are going to roll over and bonds are going to rip?
Well, that's what it has been happening, right? That's been happening since the fourth quarter. Bonds have just been absolutely ripping, and stocks have gone nowhere. And to your earlier point, most stocks are down, right? The S&P might be up 5%, but look at small caps, look at mid caps, micro caps, transports. They don't have those returns. Not that those returns are anything to write home about. And the breadth itself, right? How many stocks are making new 52-week highs? You know, Bruni and I, we run these numbers where we compare current levels. So we want to know the percentage of stocks, percentage of sectors, percentages of indexes that are above their fourth quarter highs, their first quarter highs last year, different peaks over the last few years to really get breadth from an anchored point. And we're just not seeing that expansion of breadth. So it shouldn't be surprising that the major indexes are struggling and the bonds have gotten the sympathy bid, right? Rates have gotten slammed, bonds are doing great. Gold is the odd man out. Gold, I think, is more of a currency story than anything else. While all these currencies are getting devalued, you know, gold continues to do well, right? And the dollar index, that's the curious one. It's been flat, right? So I think that's the bigger story in the gold is if the dollar rolls over, I think gold's got legs. If the dollar starts to strengthen from here, you know, euro and some of these other things roll over, I can't imagine that's going to be good for gold.
Okay. So when you look at breadth you just mentioned how nasty breadth is in the US. How about globally? Or is that what you're talking about? Are you looking at it at an international scale?
Totally. If anything, in the US is where the relative strength has been, right? We have more stocks and more sectors around here making new 52-week highs than other nations around the world that have more exposure to some of the underperforming areas. There's no question. We've done videos like this before, so it's a global lack of breadth for sure, but we're seeing it even domestically in the United States, a lack of an expansion of breadth. And the U.S. is the strongest, right? The strongest house in a bad neighborhood, right? What do they say? What's that silly saying?
The best house in a bad neighborhood.
Yeah, that's the one.
So right now, stocks versus gold and stocks versus bond are sitting right on their lows from December of last year. Do you think they're going to hold them?
But right now, I think they do. I really do. There's not really a lot of evidence that suggests that we're near the beginning of a new decline, maybe towards the beginning of a new uptrend in stocks. And I think that if stocks are really going to move forward and they're going to do well, I think this would be a logical area for it to start. But obviously, I don't have a crystal ball. I have no idea what's going to happen. What we really want to do is take the data as it comes in and help us make decisions moving forward. So if we start breaking down and we're below those December lows, you know, we really need to be cash heavy, and I think we really need to be risk averse. I think the risk is to the upside here, to be clear, but I really have no idea. If we're below those levels, got to be risk averse, I think.
All right, well, sounds good. These are very important ratios, and they're going to impact other asset classes, so we're going to be watching them closely, and we'll check back in soon.
All right, Strazza.